I'm here to talk to you this afternoon about the budget. The budget was a big spending budget, probably the biggest spending budget that there's ever been in Australia, and they're forecasting a deficit of $161 billion. Now, it is less than what they were forecasting 6 months ago, but it's still the biggest budget deficit that this country has seen. They've concentrated mainly on the pandemic spending and stimulus. In there, they're trying to stimulate business and employment, and pandemic spending is obviously protecting Australians, whether it be hospitals or vaccines or closing the borders and that. So also highlighted in the budget was the response to the aged care crisis that we have, and also there's a big amount in there for childcare. And interestingly enough, the government has put aside $3.8 billion for women, and that is protection, develop opportunities, and to try and reduce the pay gap. I've chosen to highlight some of the business tax changes here. I mean, there are a lot of them, but the government has confirmed for smaller business that the tax rate for smaller business is going to drop from 26% to 25% if that business is run through a company. If you happen to run your business through a family trust and have a corporate beneficiary, as long as you qualify as a small business, then you'll also be paying 25% tax. So that starts on the 1st of July 21. The government also announced the full expensing of plant and equipment will be extended one further year. So it was due to finish at the 30th of June 22, and now it's going to run to 23. So that's where you get the full tax deduction for plant and equipment. Motor vehicles is up to the motor vehicle cost limit, and obviously IT and all that sort of stuff. In addition, the government has announced the tax loss carryback will be extended for another year. So that's where if, for example, in 21, due to COVID, you had a loss, and you can go back a year and claim credits for the tax you paid in that year. So there might be some clients this year that weren't that affected by COVID in 2020, but have made horrendous losses in 21. They might be able to claim back some of this. And that loss carryback is going to extend for another year till June 2023. Also in the budget, there's a lot of spending on training and boosting employment. So there's a whole lot of different myriads of schemes, a lot of training. So that is going to obviously affect employment, and they're trying to get to what they call full employment, which is about 4% unemployment. For the individuals, Adam touched on the first one here, the lower middle income offset is claimable in 21, but it's also going to be there for next year. So that was originally due to expire on the 30th of June. So we've got not one more year of that. And the only way to get that offset, if you qualify, is to actually lodge your tax return. The government also announced some changes in residency. So if you live part of the time out of the country, part of the time in the country, and we have quite a few Rubik's clients that do that, they're going to simplify the rules. They haven't announced how they're going to simplify them yet, but they say they're going to simplify it. So that should be something for our non-residents or people who are thinking about becoming non-residents will need to talk to us about. The government also has increased the first home buyers super release, and they're allowing people to take up to $50,000 of their super to buy their first home. Also, there's more places in the first home buyers scheme. There's 10,000 places where you come up with 5%, the government will guarantee the other 15%, so you're not up for mortgage insurance. Once again, you need to qualify. There's issues around values of houses. They're different across the states. So a house in Sydney, the deposit is higher than, for example, a house in Melbourne. Also, one of the unexpected things was this single parents first home buyers scheme. So it's similar to the one beforehand, but it's a 2% deposit, and the government will guarantee the 18%, so you're not up for mortgage insurance too. So you can see there that the government is really pushing home ownership in this budget. There were some changes in superannuation, unexpected changes. The downsizer contribution age has reduced to 60. It was previously 65, and that's from the 1st of July. And this is where if you sell your home and you have extra proceeds, you can put up to $300,000 individually into superannuation, or as a couple, 600,000, so 300 into each superannuation account. There is no age limit on this, so if, for example, you are 80 and you sell your home, you can put up to 300,000 into super from the proceeds of the sale of that home. And it doesn't matter whether you're at your 1.6 cap or whether you don't have a super account at all. What is important though is that the age is from 60. So it's a whole cohort of people that can now do it. Also, the government removed the work test for voluntary contributions for people 65 to 75. And a voluntary contribution is salary sacrifice or a non-tax deductible contribution of up to $100,000. Unfortunately, the taxable contributions or tax deductible contributions weren't included. You still have to have the work test for that. And the government has also announced some changes in the residency rules for super funds. So previously, if you left the country for 2 years, you would not be able to run, it would be very hard to run a self-managed super. And they've moved that from 2 years to 6 years now. We don't have the legislation, so when we do, we'll talk to the affected clients. So in summary, contact us if you've got any queries.